Hello, hello, hello. Good morning, good evening, good afternoon, wherever in the world you are. Listen, thank you so much for joining me this today. It's actually evening here in Maryland. Again, my name is Douglas Eze with Lago Financial Services. I want to do a rebuttal video on a video that has been trending. Somebody sent me this video, one of my advisors, and also I got the same video from a client that sent it to me on content from Suze Orman on life insurance, whole life versus term insurance. So I want to address that and share. But before I do that, I want you all to watch this video with me, and then I'm going to come back and share some information, share my opinion, just like she has her opinion. I'm going to share my opinion, and I'm going to come in and explain some things. I'm going to show you my personal plan so you could kind of get an idea how I'm using the product, the casualty insurance, to build wealth, right? So we're going to address that. So I'll come back and talk about it. So let me go ahead and this is Suze Orman. If you don't know her, she's a very, very successful business lady. She's a TV entertainer. She's a celebrity. She's on TV. She's on a lot of stuff. So again, she has a bunch of folks at an event, and she got a question from the audience. So let's go ahead and watch this.
Here's what I always find so funny. I go out all over the world and I give talks. And I say to people, ask me your questions. And 9 out of 10 times, woman, woman, woman. And I know that there are men in this audience. And I know they're really intelligent because they were smart enough to come see me. But yet they don't ask questions. So I want a question from a man right now. All right, you, sir, yes.
Suze, thank you. Up to this point, and all the questions and answers you've given have been fantastic.
Thank you.
They've been amazing for me. My question actually then goes to future security, life insurance. I have a choice between obviously what I guess we'll call traditional life insurance versus, whole life versus term.
Yeah.
I am 39 later this month that I own a home.
Are you married?
No.
Do you have children?
No.
If you died, who would care? I didn't mean exactly like that. If you died, who would suffer a financial loss?
Nobody.
Why are you even talking to me about insurance at all? Oh, I know why. Somebody got a hold of you and told you that variable life or whole life insurance would be the greatest investment for you. You could put in all this money, possibly withdraw tax-free, do all these things with it, and it would be a great investment for you. Is that what happened to you?
I've heard that before.
Yeah, And here's what you're going to hear right now.
So let me stop that real quick and just address that. So she's talked about variable life, whole life insurance, and index universal life. And of course, again, she's about to tell them, hey, it's a bad idea, right? You also heard her say something about, who cares if something happens to you? So he's 39 years old. He just bought a house. Okay. So if he dies, who gets the house, right? The bank will foreclose. An investor like myself will go in and purchase the house, especially if he doesn't have anybody that he's leaving the property for. So the banks will put it up for sale and we buy it off and we resell it, right? That's what investors do. But let me address this. So what if this guy gets married? Because he's bought a house, right? So he has a car, he's bought a house. Now he's a potential bachelor, single, 39 years old. Maybe, he might have some a female or that he's interested in. And now they move in together and she gets pregnant. Just imagine that, right? She gets pregnant. She has a child. Now he wants to say, okay, now I'm ready to protect my family because Suze Orman told me that I didn't need it when I was single. So now I'm married. I need life insurance. So he gets married. Now he wants to buy life insurance. Well, what if the insurance company doesn't want him? What do you mean by that, Douglas? What if he's unhealthy? right? Because your health is your wealth when it comes to buying life insurance. I mean, your health is your credit when it comes to life insurance, because they look at your health. So if he's unhealthy, he cannot qualify for life insurance. So he loses the opportunity of using a penny to buy a dollar. But that's one main reason that life insurance is actually important when you're younger. I remember when I bought my first policy, I was only 25 years old. Yeah, I didn't have minor kids because my kids are grown. At that point, I wasn't married. My son was already an adult. But then fast forward later, I got married and I have kids. And I've had my policy all these years. And I'm going to share with you all later on what I did with it and why it was the best decision I ever made in my life. But let's continue watching Susie and going over high information. So let's go, Susie.
If you don't need life insurance, you don't buy life insurance. It will be the biggest waste of money you will ever make in your life. The only reason you buy life insurance is if somebody is financially dependent upon you and you die, you're responsible to them, your spouse, your children, even possibly your parents, if you're taking care of them. But if nobody is financially dependent upon you, why waste your money? Do not, on any level, touch whole life, universal life, or variable life insurance with a 10-foot pole. In my opinion, in most circumstances, they are the biggest ripoffs out there.
So remember, folks, in my opinion, in Suze Orman's opinion. In my opinion, when I'm going to share my opinion. I'm going to share my truth. I'm going to share my belief system. She's sharing her truth, her belief system. So again, folks, now you're going to have an opportunity to weigh two options. Her opinion, my opinion, and then you decide whose do you want to take advantage and listen to. I'm going to share some facts. I'm going to show some things. I'm not going to just say she's lying or whatever the case might be. I'll just show you based on my knowledge and things that I've done, and I'll show you my own plan. So stay tuned for that, because that's going to be at the end. I'll show you my plan so you kind of see what I'm doing with it. All right, but let's continue.
Life insurance was never meant to be a permanent need. It was only meant to be there during your younger years when you were building up. And once you had enough assets, then you could get rid of the life insurance. So the only life insurance you want is term insurance. It's cheap. At your age, you could get $500,000, $1 million for maybe $30, $40 a month, versus the universal or whole life that would probably be $300, $400, $500 a month. Insurance is insurance. Investments are investments. Never have the two cross. Do you all understand that? If ever an insurance agent calls you and says, there's a great way for you to invest your money tax-free, get up and walk out. That is a salesperson. You're not touching life insurance, not here, not now, not until somebody is financially dependent upon you, if ever. Got it?
Thank you very much.
Good.
So that's interesting, right? So do not buy insurance. And if somebody comes to you, run away from them, right? Because it's not an investment. Yeah, it's true. It's not an investment because it's not a sexy investment like a mutual fund, stocks, man. I invest in the stock market. Sounds sexy, right? Man, wow. I'm excited just hearing that. But so let me help you with something. And you want to follow what the wealthy people do. So I'll give you a quick introduction for those of you that don't know me. You might be coming across my video for the first time. I'm just a regular guy from West Africa, Nigeria, with no college degree, none of that stuff. But I got into this business. I was young. I was introduced to the financial service industry, and I took time to understand this industry. Yes, I got all the licenses that was required of me to get. And fast forward later, I got rid of some of them because I didn't see any value to them, because I just didn't want to be in a box. I wanted to learn what the wealthy families are doing. So I started researching wealthy families, and I started realizing, man, they do things totally different. So I'm going to share my truth with you. I'm going to share my belief system with you. I'm going to share my opinion with you. And you need to make the right decision for your situation, for your family, and what you feel is best. So I'm going to go over everything she talked about. I'm going to just show proof. Okay. So let me go ahead and share my screen. So let's do that. Let me make sure we have the slides open so you could get everything that you need out of this. So let's go in. So let's do that real quick. 1 second, folks. I'm gonna I guess I'm recording everything, so I might as well pull it up. Okay, let's go. It's being recorded. So here. So the first slide I want to start with is this gentleman right here, Robert Kiyosaki. And am I sharing my screen? Yeah, I think I am. I keep forgetting I'm doing screen share. All right, I'm not sharing my screen. I'm sorry. So let's share my screen. Okay, so now I'm sharing my screen, so it'll be picked up in the recording. So this is Robert Kiyosaki. So what did he say? Without financial education, your money will always flow to those who profit directly from your financial ignorance. So without financial education, your money will always flow to those who profit directly from your financial ignorance. Very, very important, that Robert Kiyosaki. So the first slide I want to talk about is what she talked about in terms of life insurance. So let's address that real quick. So she mentioned term insurance. So here's my take on that. Do I have term insurance? Yes, I do. And I'll tell you what type that I have, and I'll explain that. So there's two types of insurance to think about. So term insurance and permanent insurance. We're going to address that later in a few. So term insurance, it's not permanent. You could get a plan for 5 years, 10 years, 20 years, 30 years plan. Basically, you're gambling with the insurance company. You're telling the insurance company that you woke up one morning and you figure, hey, I'm going to die between now and 30 years, and then, or 20 years or 10 years. And the insurance company is saying, well, we're going to check you out. You're 39 years old, young male, and you're in pretty much good health. They have actuaries that actually look at that. These are mathematicians that are just the best in the world. They work for the insurance companies. So they look at they've already priced the term policy. And when you apply for $500,000 policy, most insurance companies are just going to hand that to you. They're going to go through a medical qualification system, right? You have to qualify based on your medical. So if you have health issues, they'll know. So they figure based on your health, they'll tell you how much it's going to cost you. So of course, like those commercials you see on TV where you're trying to buy a car, they say 0 interest for the 5-year, no down payment, none of that. But they're talking to people with great credit, awesome, excellent credit. The guy that has bad credit is not getting at 0 interest. Same thing with life insurance. When they advertise on the radio, a 40-year-old man can get a $20 life insurance for $500,000 until he applies, right? When he applies and they check his blood pressure, diabetes, those kind of health issues. Because remember, the food that we eat messes up our system and creates health issues for us later down the line. So if you are unhealthy, you might not qualify for that policy. And even if you qualify, the premium might be too high. But that's what it is. So you're gambling with the insurance company that you're going to die between that period. And then it's like you're renting an apartment. You're renting, so you're paying rent in an apartment. So think about when you used to live in an apartment. For those of you that live in an apartment currently, imagine all that money you're paying every month and every year to the landlord, right? And then you're telling the insurance company that you're going to die in the term period. And when the plan is up, you'll be too old to qualify for a new plan, or it will be too expensive for you to apply for a new one. So that's how it is. So now when I buy term, which I have term insurance, I only buy term insurance that I can convert to a permanent policy later down the line, just in case I build all this wealth, right? And I need to protect my family's wealth from taxes. So that's something else that life insurance comes in. That's a different planning where you use life insurance to take care of any estate tax that might come into play when you give all this wealth to your family. Because remember, your family's got to pay taxes on money that's transferred to them. And majority of the people don't know how to transfer wealth to their family members where they could minimize taxes. So general population, again, what happens? Something happens to us. We have all this massive estate, and because we didn't plan properly, some of us don't have a trust, we don't have a will, those kind of things. Guess what? your family got to pay estate tax. So life insurance might come in and play a role in that, but that's a different conversation. But I just wanted to explain the term so you understand. Term insurance is like renting, bottom line. All right. But it's inexpensive. I don't like using the word cheap. It's inexpensive. Second, permanent life insurance covers you for life. So what is permanent life insurance? Covers you for life, is more expensive than term, but builds equity, just like owning a house. Okay. It also may include chronic, terminal, critical illness, or injury at no extra cost. Yes, because some policies, some companies have living benefits built in. And actually, my term insurance with the company that I use, they have living benefits as well in the term policy. So I could get it on, I have it on both plans. And then you could borrow, which we call accessing the money via loan. You could borrow money in the plan, and I'm sure you my plan how I do it. And then bankruptcy and lawsuit proof in some states, you could do that. It could take care of that. So when it comes to permanent life insurance, there's variable life. Suze Orman explained that. She said, don't get a variable life. So variable life is not as popular as it used to be back in the day. So what is that? So that's allowing you as an investor or as a client or consumer to be able to invest your money in the stock market. And what they use is a mutual fund sub account. That's what they use for variable life. So it's a sub account. It has a bunch of mutual fund families, and you could have some of your money invested in those accounts, and you take the market risk. So when the market goes up, your money goes up with the market. When the market crashes, you also lose money. So that's variable life insurance. Again, like I said, it's not as popular, and most financial advisors that sell that, they gotta have a securities license to sell it. So again, but of course, there's a lot of other fees attached to that. So again, that's variable life insurance. Then we have whole life insurance, pays the fixed amount of interest rate. Some companies have 4%, some companies actually have 4.5, some companies have 5. Doesn't matter. It pays a fixed interest rate, guaranteed interest rate. And then they also have dividend applied to it. So dividend. Now, what is a dividend? I get dividend in my stock portfolio. I get dividend in my mutual fund. Well, the federal government, again, you know, Congress, there's always one politician that doesn't feel like the rich needs to continue to stay rich. So he's like, hey, listen, we need to tax these dividends that these people are getting in their life insurance policy. And they took the case to court, to Congress, and all that stuff. And the insurance company, they're very strong, they're very powerful, and you'll see that in a minute. They're very, very powerful, and they have powerful lawyers. And lawyers, the ones that are getting it, they're very smart. They know how to manipulate words and make sure things are done the way they want it done. And they went to the Congress and they said, listen, it's not the same as the dividend in the stock market. It's not the same. It's actually a partial refund of an overcharge. Huh? So, of course, they confuse the heck out of those politicians that they know what they're talking about, that want us to tax the insurance. The lawyer said, listen, it's a partial refund of an overcharge. So you can't really tax these people because we're just refunding them back the overcharge that we charged them. We overpaid. They pay less. Remember I said permanent life insurance costs a lot more than term insurance. So they say they overpaid for the insurance. We're just giving them back a little bit of money. So they're happy. So the Congress, oh, okay, cool. If that's what it is, then we're not going to tax it. And boom, case closed. The insurance companies won for their consumers, for people like me to take advantage of this policy, so that what happens, so I don't have to pay taxes on the dividends. So every year with a mutual company, they offer dividends to the policy. It's called an annual dividend. Some companies have been paying it forever. Some companies may pay this year, they might not pay next year. It's not guaranteed. So that's the non-guaranteed part on a cash value whole life insurance. So there's the guaranteed part, and then there's a non-guarantee, which means you get the cash value with interest plus the dividend. Hope that makes sense. That's the whole life insurance. And then we have inside the permanent policy, we also have what we call index universal life. So remember, index universal life came out probably in late 80s, and when life insurance was jumping off the roof and people were excited. But again, most people were losing money in the stock market. They didn't want the market. And insurance companies in business to make money, just like every industry in the world. So what they do, they went back to their chopping block and they designed a product called Index Universal Life, because they want to capture that market segment. That's what they do. I call them a manufacturing company. They manufacture product. So they manufacture what they call index universal life. Even till today, some insurance agents don't even know how to sell it. So let's talk about that for a minute. So index universal life is just like a variable life insurance, right? But the only difference is you're not investing in the stock market, you're participating in the stock market returns. For example, we use they use the S&P 500. Some people use Imagine account. I mean, it's very sexy. If you like sexy, it's very sexy. So they use that. So S&P 500, that's the top 500 company, big companies. They use that. So basically, what the insurance company is saying, hey, if the market does 20%, we'll cap your interest rate maybe 10. You get 10%. When the market goes down negative 20%, like I talked about with a variable product, when the market goes down, what happens? People lose money. With the insurance, when the market goes down in the index universal life, negative 20%, your money stays the same. You don't lose anything. You don't lose anything. You still get a what they call a zero flaw. So there's never a loss. There's always positive. So that came out and people started selling a lot of it. And right now is the fastest segment of life insurance. So many insurance agents love index universal life and they take the time, they sell a whole lot of it. The insurance companies love it and it's bringing a lot of money to the insurance company. So I hope you understand it. So really today, 2020, there's two types of insurance that's available before, that is popular. By next year might be a new one that pops out. They're always manufacturing product. So today, as of now, the one that's popular, and I'm going to address that, is whole life, index universal life, and of course, term insurance is going to be around forever. All right. So if you're going to buy term insurance that you could convert to a permanent policy, it's like renting an apartment or renting a house. You know how they do lease to own. I'm going to lease this apartment for 1 year and I'm going to own the house after 1 year. That's lease to own. So you're buying it in the potential so you could buy it later. Same thing with a term insurance. When you convert, you're leasing the term because it's renting, it's temporary until you can own it. That's what you mean converted it. And your credit is your health. Your health is your credit when it comes to life insurance. So the power of the conversion, the reason I have it, so I don't have to do medical exam. I don't have to qualify again. I'll give you an example. I just bought another policy. I have a lot of policies on myself, and I just bought one, but I didn't have to go through the medical exam. I just exchanged the face amount from a term to a permanent policy with no medical exam, nothing. I just pay my premium. So that's how that works. Hope that I know I went too far, but I want you to understand it. So let's go to the next slide. So because she said something about it's a waste of money. That life insurance is a waste of money. So let's see if it was a waste of money to this guy, Walt Disney. Some of you have taken your children to it. I've taken my kids, and man, it's the most happiest place in the world, right? That's what they call it. Happy land. Everybody's happy in Disney. So he created this vision. But when he wanted money, because me, we all have visions. We all have dream of building something and growing it and become massive. I've never met any human being that doesn't want to be wealthy. I've never met one. I've never met somebody that say, I want to be broke. I want to be poor. I just want to be nobody. That's not somebody's dream. That's nobody's goal. You might say, oh, I don't really want to, actually, I just want to be comfortable. That's fine. That's wealth for you. So I've never met anyone that said, I want to be poor. So I decided to study wealthy people. So this guy right here, Walt Disney, he bought a whole life insurance policy. I don't know when he bought it, but he had one. And when he needed to get money to start his dream, his theme park, Disney World, that we all go to, right? He went to the bank like you and I with his bag of resume, business plan, everything ready, credit, all that. And he showed up at the bank and he sat down with the bank manager and said, I have a dream. I have a vision where people will come and they'll dance with Mickey Mouse. They'll take pictures. I need money. And the bank probably laughed and said, this guy crazy. Mickey Mouse, who cares about that? Nobody wants to do that because there's what called dream killers. So it starts with, sometimes you have it in your family members, you have it with strangers, even the banks will kill your dream. And if you don't have money, your dream dies with you. So he wanted to do that. Disney was unable to acquire outside financing because the bank said no. How many of you have been told no by your traditional bank? Well, he had a policy. that he took out years ago, and he was able to take $100,000 loan from his life insurance policy to start Disney World. Took $100,000 cash from his life insurance to start Disney World. So that's how we have that company today, and they own all of Florida. I mean, it's beautiful, right? So that's that. So second person, we got Ray Kroc, McDonald's franchise. Some of us, you're eating there, you love eating there, you go there, your children love it. Well, it wasn't as, it's not a smooth sailing. I know there was a movie, kind of like a movie on Netflix. I think you could go watch it. And he talked about the two brothers that started the company, and Ray Kroc came in, gave them a great idea and all that good stuff. And, the rest is history. But listen, when he took over the business for the first 8 years, he couldn't pay his employees' salary. But because he had a life insurance policy, he was able to take cash from his insurance policy to keep paying his employees, keep them excited. Because if your employees are not making money, why would they work with you, right? They can't. They'll quit. So he continued paying his employees, even though he didn't take a salary himself, but he was able to take cash from his insurance to continue paying the employees. And look at where his company is today. Look at his vision. Look at him. He's dead and gone, and his family is still rocking that business, or whoever is rocking it today. I don't know, whatever that is. But that's just a quick example on that. But let's come back to myself, right? I have a clinic called Eze Health Center. Imagine that. A guy like me from West Africa, Nigeria, with just a high school diploma, started a medical practice for my wife when I got married. So how did this happen? Well, remember, I bought a policy when I was 25 years old. That was my first policy. And I can fund in the policy. As I got older, I put more money. So when I got married in 2010, got married, did a big wedding. I used my insurance to pay for the wedding. That's that topic for another day. But the most important thing is I took money from my insurance because we went to the banks. I had thriving business. I mean, I was doing well. Credit was great. Ex-wife's credit was great, but it's a new business. The banks said no. I mean, it's a big bank. They said no. I don't have my CPA write-up stuff. They said no, we're not giving you any money. I said, okay. I said, babe, you're a great medical practitioner. People, your clients love your patients. They love you when they come to where you work at this hospital. They love you because she was working at a hospital, and she'll come back and tell me stories about how patients, even, patients that don't speak English, but they love how she takes the time to explain stuff to her. And I said, listen, you'll be a great practitioner and run your own business. So I'll invest in you to start your company. So I invested $150,000 and we started Eze Healthcare Center. That company is still in business today. Yeah, we're no longer together, but we have two beautiful daughters. And hey, she's able to still use the medical practice to take care of my kids. And I support as much as I can, but she does a great job with them. And the business is still going and thriving. So hey, and we do, I gotta plug it, folks. Don't hate on me. We do medical weight loss and what they call and family practice. It's a general practice. So it's family medical weight loss. So if you have weight issues, you should have seen me before. I was huge, but you see how I've slimmed down, of course. So guess what? So take advantage of that. Hey, you got a plug, right? So it's Eze Health Center. So we're there in Waldorf, Maryland. So stop by and say hello. Now, Bank of America, big bank. You all probably use them. So this is their balance sheet. So what I did, I went on there and the FDIC website. That's where you go. We have a way we search for it, and we researched it, and it shows us how much they have in real estate. Over they have a certain amount of money in real estate. They have a certain money total in real estate investment. But look at how much they have in life insurance, cash value life insurance, $21.7 billion. That's a lot of money, folks. Look at how much they have Wells Fargo. This is Wells Fargo Bank. A lot of you bank with them. They have $18.4 billion in cash value life insurance. Again, these are banks that are using life insurance to build wealth for themselves. I mean, come on. What do you mean that? How are they doing it? I mean, I'll give you a quick example of that. There's basically life insurance. Banks understand the value of life insurance. So I'll give you a quick example. So Banks will loan you money to buy real estate, correct? Yes, they will. They will loan you money to buy real estate. You all know that. You have a mortgage, you took money. Did you know banks will never, ever loan you money to invest in their own stock, in the stock market? Why not? I thought that's where everybody investing. How come I can't go to the bank and get loan to invest in the market? Of course you can't. It's volatile. It's crazy. They don't do that. That's risky. Why would they? So why are you taking that risk? Okay, I'll leave you. You know, you like sexy stuff, so that's good. Remember, she mentioned that, so that's fine. But do you know that banks will loan you money to buy life insurance? What? What do you mean by that? Google it. Google premium finance. Premium finance. That's a different level when it comes to insurance, but it's for high net worth individuals. You have to make over $5 million in net worth to really get some sexy plans. That's a different conversation. Not every financial planner is understand that well, because it's a long process. And if it's done right, if it's done properly, it's designed well, your clients don't lose. So it has to be designed and built. So you have to deal with a financial professional that understands that world. So again, there's banks that are willing to loan money for that. I have a number of clients that are worth over $5 million in net worth that we've designed this for. We can also do plans for them, you know, for executives as well. But that's a different conversation. So my point is, Google this for me if you can. Boli, B-O-L-I, B for bank, O for orange, L for Larry, I for investment. Boli. Go to Boli, just Google it, Boli. Bank owned life insurance. Google that. Bank owned life insurance. Owned, O-W-N-E-D. I have to spell that out because of my accent. Bank owned life insurance. Google that. And then also Google corporate owned life insurance. COLI, corporate owned life insurance. So my point is, if life insurance is good for all these big corporations, why are you not taking advantage of it like they are? I just showed you Disney individual. I showed you Ray Kroc individual. I showed you my plan. When I started young, is it a waste of money? Today, no, it's not. My ex-wife is enjoying it. I use life insurance for so much stuff, and I'm going to show you that, you know, real estate investment, hard money, so much things that we do as a group with my team and my friends that I bring together to do stuff. So is it a waste of money? No, 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 no. So again, that's my opinion. That's all I'm saying. So let's, you know, so that's it on that. So what I want to do next, let's go in, because let me make this smaller so we could exit out of this guy. So now we're here. So let's look at spreadsheets. So let's start with whole life. So this is a whole life insurance on a baby. So I want to start with an age 1 year old. All right. So let me bring on my marker. So in this case here, right, you have a baby. So remember what she said. It's not a great, it's the worst thing ever. And I've seen so many parents that say, I don't want life insurance. My child, I don't believe in putting life insurance on children. See, because again, they listen to Suze Orman and they feel, oh, my child is not bringing in any money, so I don't need life insurance. If that's the case, then the insurance companies will not sell policies to children. They'll have a age and say, okay, you can't buy insurance until you're 40 years old, right? They'll say that. But they sell policies to babies. Why is that? That got me curious. I'm like, why are they selling policies to babies? And I started seeing why. So I'll use a simple example. So this is $100. I didn't want to use a company name or anything, so I just did a spreadsheet real quick. So please, these are real numbers from an insurance company. I just don't want to mention their name or nothing. So $1,200. So that's $100 a month. All right. This is a whole life insurance policy, because remember, she talked about whole life. So I'm addressing whole life. So I'm going to address whole life first, and then I'm going to address index universal life. So there's the guarantee section. Remember, I talked about that, right? Where there's a guaranteed interest rate, and then there's a non-guaranteed. That means the interest plus dividend. So let's use an interest of 4%, you know, because there's some companies that pay that actually. There's companies that do that, guaranteed, and then plus dividends. So if you notice in this case, the guarantee is $496, and then the dividend is like $2 more. So it makes it $498. So that's the dividend. So in this example, we're going to just go all the way to age 20. So let's look at age 20. So make this, so age 20 right here. So let me bring my marker again, please. So we got age 20 years old. All right. So now, you know, the policy has $25,000 cash in it. And on the non-guarantee section, $25,000, the death benefit is $283,000. And right here, $22,217 is the guarantee section. So you might say, man, I paid, so $1,200, just simple math, 1,200 times 10 years is $12,000 times 20 years, 1,200 times 20 is 24,000. So the guy put in $24,000 of his hard-earned money. Now, let me explain something too to you about life insurance, all right? So you understand. And so just to keep the math simple, when I show you my plan, you understand why I'm keeping it simple right now. So the first year you put in $1,200. Let's use this number, this $1,200. So the way I explain it, all right, a portion of this money is not like a dollar for dollar. So I'll say 50% of the money goes to the insurance company. Again, this is an example. It's not actual accurate number, but it's an example. So 50%, so let's say $600 goes to the life insurance company to protect your life. That's the death benefit, all right? So it's not too exciting, right? That's that. Then the other $600 goes towards your cash value. So that's where you earn that 4% interest rate. So a lot of times, this, of course, is people look at that, man, if I put $1 in a bank, I get $1. If I put $1 in investment in stock market, I get $1 plus my interest, right? Yeah, I get it. I understand. But here you put $1, you're not just getting the death benefit, which is the one you like, I don't care if I die, nobody is there for, but you get a cash value and it starts building. See, slow and steady wins the race, right? You got to be patient with everything in life. I mean, when it comes to wealth building, you got to be patient. Some of us are so much in a hurry to build this wealth, and we don't realize, wait a minute, I got to wait and build so I could take advantage of the opportunity that presents itself. I remember one of my wealthy clients said to me one time, he said, Douglas, there's always going to be opportunities, right? The key for you, Douglas, is to have the money ready to take advantage of the opportunity. So in this case here, when the opportunity presents itself, this 1-year-old that is now a 20-year-old has access to 25,000 or 22,000. Remember again, folks, 50% goes to the life insurance of the premium, the other 50. But if we're keeping everything the same, as if there was no money going to life insurance and all the money was cash, right, that went to the insurance policy. But in 20 years, when the client's 20 years old, $25,000. So if they put in 24,000, so it's like they netted $1,135, right? They got back all the money they put in and they made a little bit of profit. Or this one here, 22,000. So they put in 24. So it really cost them because they got back 22,000. So it cost them $2,000 for the policy. If this guy dies and he only put in 24,000 and he dies at age 20, his family's beneficiary will get a check for $283,000 tax-free. I didn't say that. Tax-free is what it is. Now let's go to when he's 39 years old. See, 39 years old. Now he has $61,000 in his policy, $80,000. So you do the math. 1,200 times 39 gives you a number. Whatever you do the calculation, I'm not going to do it in this call. So 410,000 is the death benefit. So that's the whole life for a baby. So what's my point? At age 39, how many 39-year-old today have $80,000 in their bank account? How many 39 years old? Think about it. If that guy was 39 years old, had this policy when he was a baby, now he's 39, he'll have $80,000 cash that he could access to maybe start a business, maybe pay off his student loan, maybe buy a house, whatever he chooses to do. Because opportunities present. I'm in my 40s now, right? There's so many opportunities that present themselves. I'm like, man, I could take advantage of them. Maybe it's real estate or whatever the case. Imagine that you set your children up to be wealthy. That's the whole point of setting up buying insurance on kids, and I have it on all of mine. It's a way you set them up to build wealth and grow their wealth. So that's one. So let's go back. Let me pull up another one here. Another policy. So he's 39. So we use a 39-year-old. So again, same thing. She used $500. So I'm just using her numbers so to address this. So $500. And if you all notice something, my whole life policy actually builds cash from day one because of the way I build them. See, there's different ways you could design a whole life policy. Some agents, they're not familiar, so they don't know how to build them properly. I know how to build them. We have designs that we do. So we do it, and my sales force knows how to do it because we train a lot. We believe in training our agents to be the best and the best in the industry so they understand the business well. So in this case here, he puts in 6,000. So this is the 39-year-old. So he decides, you know what, because he's single. So here's the main reason why he needs policies like this instead of a term insurance policy, right? For which gives you a larger amount of coverage with lower premium. In this case, at least he's using his money twice. So he buys the policy, he's building cash. Remember, I talked about that. 50% using that, and they so understand that. But look at this. At age 49, he's going to have $65,829 in his cash value on the non-guarantee side. That's with dividends, or $58,828 in his guarantee section, which is the 4% that I talked about earlier, using that number. All right. But look at that. At age 65, I wanted to go to 65 when he retires from his job, his good government job, or whatever job he's doing. In addition to his retirement, remember she said something about, oh, they come to you with tax-free retirement. Well, he happens to have $233,000. Is it tax-free? No, if he pulls all that money out, he's going to pay taxes on the profit. But guess the reason it's tax-free, let me give you the secret. The reason it's tax-free is because he's going to access it like a loan. When you take the money like a loan, just think about your credit card, right? When you borrow money from your credit card, do you pay taxes on that? You just pay interest to the credit card company, 18%. And so many of you are so happy paying that 18%, where you take a loan from your insurance policy is only 4%. Some companies charge 4%, some companies that charge 8%. So it's between 4 and 8%. So it's up to you to figure out which company are you dealing with that's charging you that high. Because with insurance, you will get it for 4%. Simple interest, very, very different, but that's a different conversation. But he has $233,000. If he calls the insurance company and says, hey, I need $200,000 as a loan me $200,000. Guess what the insurance company will do? They'll send him a check for $200,000. His $233,000 stays in his account, earning interest. And what they'll do, they'll put a lien on his $233,000. They'll put a lien of $200,000. And now he only has access to 33 because he already took 200,000, maybe to buy a property for his daughter, maybe to pay for college for his daughter. Whatever he wants to use that money for, he uses it for. It's totally up to him. And then, like the way I teach it, you pay the money back. Treat it as if you went to Bank of America or Navy Federal, or wherever, one of those banks, and treat it as if you took a loan from them and pay yourself back the money. And when I say pay yourself back, the reason I call it that, I'm not saying when you pay the money to the insurance, you're not paying it back to yourself, you're paying it back to the insurance company. But what I'm really saying is once the loan is done with the insurance company, when you finish paying the insurance company, what are you going to do with that monthly payment? So what I do when I borrow money from my insurance policy, I treat the money as if I borrowed it from Bank of America or Navy or wherever. I go on their website, see what their personal loan interest rate is, and then I use their calculator, and it tells me how much I need to pay myself up. Because the insurance company, they don't give a care if you pay them back or not. Because if you don't pay them back, when you pass, there's a death benefit here of $544,000. Those subtract the $200,000 from that, plus any interest that I accrued, and then they give the rest to your beneficiaries tax-free. So what I do, because I don't know when the next opportunity is going to come. So what I do, I pay them back, and I pay them back quickly so I could get away from paying them interest. And that's a total different conversation, but we could have that another time. But I don't want to, because I know you guys are watching this, so I don't want to spend too much time on it. But I got tons of videos on YouTube, so check out my YouTube channel to learn more stuff. All right, so that's that. So let's look at an index universal life. So let's find that. All right, so index universal life. So I'll bring up again the the young kid, the 1 year old again. So index universal life is different from whole life because the index is based on the stock market, right? The S&P 500. So it's sexy. It's S&P 500. I'm investing in S&P 500. That's sexy, right? But you're really not investing in the S&P 500 because you're not taking the risk. The insurance company is taking the risk. They're investing the money. They're doing whatever they're doing with the money, whatever money, the way they do it. They're just mimicking what the S&P does, and they give you an interest rate. So they're just guaranteeing you that, hey, you're not going to lose any money. When the market does so amount, we pay. So there's two ways insurance companies do that. So it's just their way of doing business. So that's fine. So in this case here, if you notice, the guy puts in $1,200. Okay, $1,200 comes in as a baby. You set it up for your kids, so that's what you're paying. All right. This right here that says client dollars, this is what they call accumulated dollars. This is the money you have accumulated. If you notice, it's $855 immediately in year one. All right, that's how much you have built. But what is this dollars? This says zero. So the first 2 years, there's $0. What does that mean? Well, that's the insurance company money. That's what they call surrender. If you cancel the policy, the insurance company will give you $0. But if you notice something, the death benefit is also increasing because they add the cash value plus the death benefit together becomes one. So that's how they build it. But in this sake of this training, we're just going to focus on these two sides, the client dollars and the insurance company dollars. So after 10 years with this particular company, after 10 years, if you notice, which is actually year 11 right here, all right, the death benefit and the cash value is the same. I mean, sorry, the client dollars. Let me clean this up a little bit, folks. Sorry, I apologize. So in year 11, 131,196 is in the client dollars, and then you look at this section here, 131,000 is in the insurance company's dollars. See that? So in that example, you see the money is the same because now there's no more surrender penalties. It's done, which means if the client cancels the policy, so the first 2 years they cancel the policy, the client gets no money. If the client dies, though, if they die, because death is not something that we control. Canceling the policy, we control that. Death, we don't. So if the client dies, the family will get the death benefit, you know, which is the $160,910, which is already included this $17,000 in there. So that's what makes up this $160,000. All right. As you continue to build, the policy continues to grow, as you can see. So why am I sharing this? Well, at age 21, which is age 20, really. All right, let's use that. Age 20 right here. All right, age 20. The client now has $34,787 on both plans. Because remember, this is not a whole life. This is an index universal life. So it doesn't have the dividend. Index universal doesn't pay dividends. It's not a dividend paying opportunity for that. It's not participating. It doesn't pay dividend. Just pays interest rate based on the market. So the market could be zero. That means you didn't earn anything. So that's the only difference between the index and whole life, the manipulation of the market and all that good stuff. But in this case, again, $1,200 times 10 years, that's 12,000 times 20, that's 24,000. So we put in 24,000 in this case. And again, same example where 50% goes to the insurance, 50% goes to the cash value, right? So using that number. So 24,000 total we put in, and we have access. If everything is fine, the market stays, this does what it needs to do, and this client earns a good interest all that time, he'll have 34. So he made a profit of $10,000, basically profit. Now, of course, if he cancels the plan and walks away, the IRS will tax him on this 10 grand. That's the difference between what he put in and the gain. So this is the gain. But if he takes a loan instead of canceling, so there's no taxes on that, on the loan, because it's a loan. Now, of course, if the policy cancels and you didn't pay back the loan, then the insurance company will have to send a 1098 to the federal government or whatever. I mean, you know, the interest that you have to pay, and then you have to pay all that taxes, because now the tax is no longer a loan. The loan is not due. It's just like, I'll give you an example of that. You know, all those companies that say, hey, we'll help you fix your credit, and we'll also pay off your loan. Debt consolidation, we'll negotiate for you. And you used to owe $50,000 to this credit card company, and they negotiated down to $20,000, say pay $20,000, and don't deal with it anymore, and you're done. And they work out a deal with with the credit card company, and you pay 20, and now you don't have, you're debt free, right? Until the IRS sends you a bill in the mail, because that bank, that credit card company does what? They report to the IRS that, hey, that guy, we paid him income. He got $30,000 income, because now it turns from a loan to income. Now you have to pay taxes on it. Same thing with this. If you cancel your insurance policy and you have you have more money in there than the cash that you built. So be very careful when an insurance agent comes to you and say cancel your life insurance policy. Because that's two things is happening. They're making money for the insurance company. Why do I say that? Well, because the insurance company didn't have to pay out this claim. They didn't have to pay out this claim. So when you cancel your life insurance policy, you just made money for the insurance company. So they've just made 197, because they didn't have to pay out a claim, and they only gave you back 34,000. But you know how much billions they've made? You think the insurance companies don't make? They're in the business to make money. So don't cancel your policy willy-nilly without asking questions, right? And if so, I'll sound like Susie now. If an insurance agent comes to you to say, hey, you need to replace your policy so you could buy this other new policy, or run away from that agent. Run, pick your stuff and start running, right? If he asks you, say, I'm just running. Don't even look back. Go, run. If they're trying to replace the policy you currently have, unless that policy is totally bad and they need to explain to you why it's bad. Other than that, if he's saying, oh, you could get a cheaper policy for this, run away from that agent. He's just trying to make commission, and he's also trying to make a sale. Okay, so run from him, because that's not the way you should be. You shouldn't be canceling any policy if you don't have to. All right, so that's my thing for you. So I used to be one of those agents back in the day when I didn't know nothing. That's why it's so important that you do your own research. Until I said, you know what, I'm going to just research this. I'm tired of listening to folks in the business that just look out for their own money. I'm a consumer. I need to be treated like the way I want to be treated when I go to somebody and I don't know what I'm buying. I'm trusting that person to help me design my plan properly. So that's the same thing. So understand, I know went over, but I feel you guys need to know this, and it's important. So again, very important. So let's imagine this child now is 39 years old. So he's sitting in Suze Orman's class, like she mentioned. Look at how much money he has now, $150,000 in cash value. Again, of course, this is all hypothetical. It's not guaranteed. It's based on the market. Everything is hypothetical when you're dealing with the stock market. Nobody can ever guarantee you that the market is going to stay the same interest forever. Like if, like you're talking to an investment guy, mutual fund guy. Well, I've been averaging over 10% for the last 20 years, but it's an average rate of return. That's a different conversation. I actually have a video on average versus real numbers, right? So watch that sometime. But for now, let's just deal with this. So $150,000 cash, right? So again, you put in $1,200. You do the math. I haven't done the math on it times 39 years. It'll give you a number. You take that number and figure out how much money you've put in. So now in this case, $150,000. So this guy's 39 years old, has $150,000. Look at the debt benefits, $375,000. All right. So he has the money now to do what? Whatever he wants to do. Right? He could cancel and walk away. He could take a loan, which I always suggest. Take a loan. Don't cancel. Take a loan. Take a loan and use that money to invest in businesses or other returns or whatever it is you want to do with the money. But pay it back to yourself. Always do that. All right. So that's that plan. Again, let's look at him now at the age, he's at the Suze Orman show, or, because that's what we saw him at. So that's 39. So what if he sits down and buys a cash IUL, Index Universal Life? Again, doing the same example, just like the first example we use on a baby. So you see that the accumulated dollars, $4,935 in the first year. And it's the way I designed this. So the way I designed this particular, because older people have other options. The children is okay. It's only $100 a month. So it's fine. But this guy might need access to his funds. Some companies with Index Universal Life, you have to wait a year. So the first year, he has access to $1,189. Even though he has $4,935, the insurance company say, hey, we can loan you $1,189 if you need to get money. If you decide to cancel the policy, well, you're out of luck. You're going to get $1,189, and we're rich. We're going to stay rich. So don't cancel your policy. keep it going. Now, this guy here, fast forward here, 14 years. Now he has $93,999 in his cash value life insurance. Look at his death benefit, $284,030 in his death benefit. If he dies, that's how much the family gets tax-free. This is how much cash he has in this policy are they in 14 years. What about when he turns 65? So let's look at that. So 65. Let's go there. And 65, he has $326,000 in his policy at age 65. $326,000. That's a lot of money, right? Look at his debt benefit is $516,000. So again, he accomplishes his goal. He gets to the $500,000 we're looking for. Yeah, it took him time to get there, but he got there. If he died, his wife would get a check for $516,000. Whoever the lucky woman is to marry that gentleman that was talking, but his cash $326,000. So again, do the math. He put in $6,000 every year for 10 years, for 28 years. So 6 times 10 is 60,000. 120,000. Very simple way to do it. Just keep it simple. 120,000. 30 years, 180,000, right? Okay. So yeah, that's where I stop. I don't want to overdo myself. So, but he has $326,000 cash. Cool. Can he do something with that money? Yeah, maybe he could. There's some people in their 401k, that's all they got in their 401k. They have less than 326,000. And remember now, when they pull it from their 401k, they gotta do it as a withdrawal, which means they gotta pay taxes to the government. Isn't that something? And they don't have any choice because they retired. They can't just take a loan at that point because the job, you're no longer working there. So how are you going to do it? So most people roll it and then they start drawing income and they run out of money. At least this is a supplement. It kind of gives you extra money without you paying any tax. And the only way you're going to do that is you take it as a loan. Now you could withdraw the money. If you withdraw, now you got to pay taxes because of withdrawal. And if there's anything above your gain, it might trigger some situation. So be careful when you do it. You could withdraw money from your insurance policy or you could take, but when you withdraw, you just cannot put the money back. And I don't like withdrawal. I do not like it. Whenever you withdraw money, we as human beings, we've been programmed when we withdraw money from our accounts, from ourselves, from our bank account. How many of you pay back that loan? I mean, that withdrawal. Do you put the money back with interest? No, you don't. You might put back the principal, but you don't put the interest back with it. So I teach you a different way of doing that, but we're not going to do that today. So I just want to cover that. So then the final thing I want to show is my own policy. So let me pull up this one here. That's not what I wanted to pull up. All right, so let's pull up this plan here. So this one here, why am I showing this? Because I want to show you something that I'm using so you kind of see. So I'm going to show two policies. So the first one is this one here. So this one I kind of funded, it's a younger policy. I put about $11,000, premium, $11,000 a year in this policy. I could put more in there, but right now I only put 11,000. I'll show you why. All right. So, but that year between May 2019 and May 2020, that year, I made interest $2,000 in my account based on the S&P. See, this is index strategy. It's an IUL. This is S&P. Remember that sexy guy I talked about? S&P 500, right? So I kind of have different segments: point to average, point to cap focus, point to point participation. But I have more of my money in the point to point cap focus. So I put 38% of my money spread out into that. So I made $834. The rest of them I made $392, $390, and then I also have a fixed account that pays a 3% rate, because that's where the basic money. So when I put the money in, it goes and sits there, and then they distribute it into the market. So that's just what that is. But it gave me 3% on that. So in this example, I made $2,000. So how does it work? Well, my fee is this. It's about $4,000. I did the math on it. So in this case here, it's about $4,000. Let me show you what I mean by that. So let's kind of go right here real quick, the calculator. So it's about $4,675. Now it might be a little bit higher or less than this plan, because this one is 4,000 something. I'm going to show you where I got this math from. I'll show you that. That's on my next statement, another policy that I have. But this one I'm paying 11 grand, and this So let's just say 4,500 here. So I'm more about that, so that's fine. So I pay this fee. They credited me $2,000 in interest. So again, my total premium paid that year was 67,300 because I'm not max funding it. I'm not funding it to the fullest. I'm not really doing that with this plan, but there's room for me to do that. There's room for me to do that, and I do. I'm working on a project right now that's going to pay out. Once that pays out, then I'll dump a lot of money into this policy. But that's a different training. But second plan, this is a different policy that I have. And in this particular policy, if you notice, I'm putting $21,000. So the other one, I'm putting 11 grand. This one here, I'm putting 21,000, which is the maximum I could put in. So again, if you notice, the statement date is August, which is my anniversary, to August. The other one was May to May, right? So that's an anniversary. So this is a 1 year. So my new statement for 2020 is not going to be out till August 2020. So again, this account, if you notice, I only have one S&P account in this, right? I didn't segment it like I did with the other plan. And the basic strategy in this particular plan is a different plan from the first one, is 2.5%. That's the bottom. And then, but I made 4.9. Right? So I didn't make 6, like the other one. I made 4.9 because it's a different plan. But this one I've had longer. Have this for a long time before, when I first started. It was I used to put in $150 a month, and then I've increased it along the years, and now I'm putting in $21,000 a year into this particular policy. I have about 7 life insurance policies just on me, 7 of them that I use for different things. And I bought them along the years and built them that much because I use them as a bank. And I have policies on my kids and my mom and stuff like that as well. So, but it's a different conversation. So this is the math I did earlier. This is the $4,000. The one, let me pull up my calculator so you all could see what I'm talking about. All right. So this is the math I did. So that's 4,675. So that's 713 right there. That's 1,266, 2,600. So because I'm max funding it, I'm putting 21,000. They charge me 4,675. But remember, I made 14,000 interest. That's on just the plan, right? But here's what happened. Let's break down the loan details. So let me bring this up a little bit. So the loan details. So what happened here? I loaned money back in 2018. I borrowed $185,000 from the policy. I took a loan for $185,000. They charged me interest, $5,967. So what did I use this $185? That's a lot of money, Doug. What did you use that money for? Oh, no, I used it. I used it for investment, to make money. Come on, what do you think I used it? I didn't go shopping. I didn't go buy Louis Vuitton bag. I didn't do all that. I mean, I have those things. I use a different money for that, but I used to go make me more money. Basically, that's the bottom line. I went and made more money than the insurance company would give me. So I went and made more money for myself. And yeah, they charged me $5,000, but that's fine. I made 14,000. So what is the net on that, right? So probably, let's say what, $9,000. So I profited $9,000, paid the insurance company back $5,960. I don't care. That's fine. But now check this out. I also paid back $216,000 back into my policy. $216,000 cash that I paid back in the same time frame. And then I went back and I took another loan for $250,000 to go do other business. See, that's why I haven't had time to put money in the other plan, because I'm constantly using money to do stuff. So 250, I borrowed it and I went and did other business. Now, when those business pays back, then I'll pay back the insurance company, pay back everybody, and I'm happy. And life is good and no stress. I still have an 850 credit score. That's my credit score. It's crazy, right? I could borrow money. I have cash. I could do things. I could go get a loan from a bank. I could get a loan from the insurance company. I give myself options. Suze said it's a waste of money. Do you think this is a waste of money? Do you think it's a waste? You tell me. Ending amount loan. So now I owe them $225,000. That's fine. I ain't tripping. I ain't worried. They don't call me. That money don't show up on my credit report. Nobody knew except you guys today. Now you know. Douglas is in debt. $225,000 debt. Kill me now. Folks, listen. Understand this, people. Life insurance has its benefit. It has a lot of benefits, and I want you to do your research. All right, we're using our money twice. If something happens to me, the insurance company is going to pay out the death benefit that's on my life. They'll subtract the cash, the money I loaned from the policy. Let's say it's 225. My beneficiary will get whatever profit that I use this 250 to buy. Let's say I bought a real estate property, right? Or whatever the case might be. They own that. It's free and clear. And they still get money from the insurance company tax-free. So it's a win-win situation. And one thing that I show you is how you could tie up your money well so nobody can take the money from you. So those are some of the things, but that's a different conversation. So folks, I wanted to do this because this is so important. And again, for all you financial advisors, agents, and all that, that you're out there, make sure you're doing the right thing for your customers. Because if not, there's going to be people that's going to come in and replace the policy. And if you're an agent and you're watching this and you're a believer in the other concept that Suze teaches and Dave Ramsey teaches, that's okay too. But I need you to step outside the box and look back in and start looking at information. Do your own research as an insurance agent. See, I did that. I did a research to understand this process. And then I started using the plan for my own life. And I started seeing the benefit to it. Imagine if I had listened to Suze few years, 20 years ago when I first got into this business. Over 20 years, actually. Whew, time flies. That I started in this business. I started when I was 24. Man, whew. It's a long time. So if I started using it then, I bought term and I didn't believe in cash value life insurance, and I didn't have a mentor that said, hey, get a plan like this. Imagine what I would have done. I wouldn't have been able to pay for a clinic. My ex-wife now, she'll be still working a job, right? She wouldn't have the medical practice to use. I wouldn't have businesses that I've invested in, that I've helped save them or whatever the case might be. Now, of course, whatever you do, you got to do your research. Don't just jump out there. Even when you want to invest in real estate, don't just jump and invest. Do your research. Understand. Don't buy the hype. Because if you don't know for yourself, people are going to take advantage of you. So make sure when you're dealing with the financial person, have them share what they're using, whatever it is they're going to show you. Tell them, show me your plan so I could see. I'm not telling you this is an investment that you need to go in and scale and run. No, this is a place to park money. Life insurance is a place, it's a garage. It's a parking garage to park your money. So think about a parking garage. Think about a car, right? You buy a car, a brand new car. You drive home. You have two places to park. You could park in the garage, or you could park on the street. If you park on the street, what comes to mind? You're scared, you're worried at night, you're thinking somebody's going to steal your car, damage your car, or whatever the case might be. But if you park in your garage, guess what? You'll feel like, wow, you're safe. You sleep like a baby. Same thing with money. Money, you could do two things. Either you're spending it or saving it. Now, also, where you parking money? You could park money in your house. You could park money in your 401k, in the stock market, in mutual funds, CDs, in money market account. Those are places you park money. Life insurance is also a garage where you park money until you're ready to use the money. So when I'm saying garage, until you're ready, let it build up until you have the right opportunity that you can invest in. There's so many different opportunities. You could buy property. There's some places you could go buy property for like 10,000, 20,000, auctions and stuff like that. But you have to have cash to do it, right? So you want to park your money and then just wait. Keep adding, keep parking the car in the garage, keep parking money in the garage, in the money garage. And I use life insurance garage because it's just protected a little bit different. My life is protected as well, because if something happens, my family will get the money. Because you all know we're all going to die one day. That's a given. Nobody's going to leave this world alive. So life insurance is a good place to park the money and then use it to scale. Again, thank you so much. I know it's a long video. Please understand, is to educate you. Please understand that. And I appreciate you for taking the time to join the call, to watch this video. Again, please help me, do me a favor, right? Share it, please. Share the video. If it made sense to you, share it with your friends. subscribe to my YouTube page. Please do that. And if you have a comment, share your comment. I'll read your comment. I'll respond to your comment. And hey, listen, continue success. You've heard from Suze Orman. You heard from me. And now it's your decision time. You decide what makes sense for your family and for you. Okay. So again, I appreciate you taking the time to join me this evening or this morning in your town or this afternoon. Now, of course, this is going all over the world. So some of you in your countries, I don't know if you have cash value life insurance, but seek out an agent. Find out there's an organization called $1 Million Roundtable, MDRT. Go on their website and look at agents in your country that might be a member of the organization. Most of these agents have been trained and they consistently stay afloat. So make sure if they're a member, ask them, and then that might be a good, the MDRT might be able to refer somebody to you in your country because the MDRT is all over the world. So go check that out. All right. Again, thank you. I appreciate you so much for taking the time to join. Have a great evening or great morning or great afternoon. Bye-bye.